Canadian companies are continually doing business in the U.S. It's the biggest foreign market. They're transacting in U.S. dollars. When reporting to Canadian tax authorities, the requirement is to convert those U.S. dollar transactions to Canadian dollars, either at the transaction date exchange rate or an approximation of that transaction exchange rate, to then get it in your statements, your financial statements, in Canadian dollars. Those financial statements are used then to report your activity to the Canadian tax authorities. In respect of U.S. filings with U.S. tax authorities, the first question one needs to determine is, do you have a permanent establishment or a place of business in the U.S., both from a federal and a state perspective. The state term is a term called nexus. A permanent establishment or nexus can be created by having a physical presence, an office, or by virtue of the extent in which you're doing business in the U.S. As an example, if employees are providing services to your customers in the U.S., the physical presence of employees in the U.S. could trigger a permanent establishment or nexus at a state level. If you have a permanent establishment or nexus, then that will trigger a requirement to file a federal or state income tax return. You should also assess the extent to which you have state and local tax reporting requirements, similar to our PST, provincial sales tax in Ontario. If you do not have a permanent establishment or nexus in the U.S., then it's unlikely you have any U.S. tax filing requirements. The other thing you'll need to consider is, if you do not have a permanent establishment, will your customers withhold payments to you for your services? And so often what happens is your customers in the U.S. will ask you to confirm that you don't have a permanent establishment, and that's done via a form called a W-8-BEN. And so you'll have to fill that form out, confirming that you do not have a permanent establishment, and then your customers will be able to pay you without withholding tax. It's obviously a complex area, and so companies should really get advice to make sure that they understand their income tax requirements. And similar to Canada, there are also state and local taxes that also could be in effect if you have an establishment in a state. Foreign currency exposure arises when you sell or buy at one date and you pay at a later date. And as that foreign currency changes, the amount that you receive or pay will fluctuate, and that results in a foreign exchange gain or loss. Two strategies to mitigate that risk of gain or loss: what referred to as natural hedges, so maintaining a bank account in that foreign currency to receive and pay the foreign currency amount, or maintaining receivables and accounts payable of equal amounts and equal timing to effectively offset that exposure. For companies doing business in Canada, in Ontario, they have an obligation where they've got employees to collect and remit payroll taxes, including Canada Pension Plan, employment insurance, and employer health tax. The employer health tax is triggered when salaries exceed $450,000. In order to remit those payroll taxes, you have to have a payroll account. In order to get a payroll account, you have to have a business number. So once you have a business number, you can apply to get a payroll account. And then on the 15th of the following month, those payroll taxes need to be remitted to the tax authorities. Annually, you'll have to prepare a T4 summary. That T4 summary will summarize the total employment paid and the respective benefits. That T4 summary is due to be sent to the tax authorities at the end of February. One final requirement that companies have in respect of contractors is annually summarize the payments made to contractors and report that information to the tax authorities on what's referred to as a T4A slip.